You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, a fine mess the Fed has gotten us into. Can they get us out? What is going to happen for 2022? It could be dire. And then again, it could just be another day in the park, right? Well, let's see what our good friend Octavio Marenzi has to say. Opimas, OPIMAS.com. Octavio, it's great to have you back on. So, hey, you seem to be like really pessimistic about the future of the stock market for this year.
I wouldn't say that. I think what we're going to see happen is the Fed is going to carry on restricting its monetary policy and driving interest rates up a bit. We've seen that a bit over the course of the past few days, and today in particular. But the 10-year Treasury still remains at a very, very low rate historically. And already the market is starting to object and come down. So I think what we're going to see happen is the Fed will carry on doing this for a while until the market, I wouldn't say crashes, but corrects like 20, 25% or something like that. And they will turn it around, do an about face, and start pumping money back into the market to support it and push it back up to record highs. So I think we're going to go through a very rough ride. It's going to be a very, very volatile ride in 2022. I don't know by the end of it where we'll be. I don't know exactly when what will happen, how long each phase will take. But I do see that happening, basically a tightening of monetary policy, pushing up interest rates, a crashing of the market, and the Fed returning thunderously to bail out the market and jump within more cash. Now, that could take a year, that could take 9 months. I don't know how to time that exactly. That is the art of trading, I suppose, more than anything else. And if I could get that perfectly right every time, I'd be a multi-billionaire at this stage. But that is, I think, the way things are going to unfold in 2022.
So the markets are going to crash, eh?
I think we're going to see a pretty good correction at some stage in the next few months, probably within 3 or 4 months, at half a year at the most. So I think that's about the timing of it. And we're seeing an inkling of that already. We've seen sort of slight corrections on the market already, and I think it's going to accelerate.
What if everybody's wrong and we're just looking at instead just a normal 20% correction, and then everything goes on? Because as much as they're going to raise rates, are they going to raise them enough to challenge the stock market's primacy in terms of generating returns? Can that really happen?
I think the only thing that can really happen to make that come about is if inflation becomes an enormous political liability for the Biden administration. I think there's some indications that it is going to happen. So the Biden administration is very, very worried about inflation. It's a very, very unpopular thing, particularly for people on fixed incomes or people who feel that their incomes are not keeping pace with increase in prices. So we already see the Biden administration sort of sniffing around the oil industry, accusing them of colluding with each other to jack up oil prices. We see them saying this about meat packers and things like that. I think we're not far off from them really sort of starting to do something dramatic for those kinds of prices and say we're going to put some sort of price controls into place, but then also put very heavy pressure on the Fed to get them to rein in inflation by increasing interest rates. So it's competing interests. So the question really is the Biden administration, how much are they beholden to your average worker in the street who feels that inflation is putting a real pinch on them, and how much are they beholden to Wall Street, and which of those two factors are going to win out? It depends. I don't know where the balance of power there really lies, but I can say that inflation is going to be a huge political liability for the Biden administration in the coming year.
Yeah, well, they don't seem to be acknowledging it now. I personally believe that rather than 20% interest rates, they'll opt for blaming capitalism, blaming the greedy capitalists for it, and they'll opt for wage and price controls.
You know, you might well be right, but those things don't work. I mean, they're dramatic. They're dramatic in the sense that they make it look like you're doing something, but inflation finds its way around those kinds of price controls, and people start to hire people on the black market or illegally, or they start trading things out of view, and the prices, they'll be the official price, and then there'll be the real price. Just like in the Soviet Union, there was always an official price, and then there was a real price that people actually paid for things. And that is what you'll see. And they'll be able to keep head headline inflation under control nominally, or claim they've done it. But really, when you want to fill your car with gas, you're going to pay a lot of money for it. So those things never work. They always exacerbate things. And then they'll be back to the stage where they need to do something about inflation. Having gone down this bizarre detour of price controls that have never worked anywhere that anyone's tried to implement them.
Okay. Well, we've seen them make these mistakes before. We've seen them blunder, and inevitably they will take the easiest path and not necessarily the most effective path, just like Nixon did in 1970 when he imposed wage and price controls. And like you say, we saw how effective that was. Yeah,
I mean, he just slapped in price and wage controls right across the board and just said no one can increase their prices or wages. Now, of course, there's all sorts of ways you can get around that by saying, well, this product I'm selling is not exactly the same as the product I sold before. It's just slightly different, or we put some additive in it, or we did this or that and the other. So there's all sorts of opportunities to sort of game the system and make that happen, or to say, well, it's not exactly the same kind of labor, so we're giving you a different position, therefore we pay you more, things of that sort. So these things are very, very porous and very, very difficult to implement, and so I don't think they'll be terribly effective. And I think you're not going to be able to contain inflation by doing it, because it's a monetary phenomenon, and you're not going to be able to contain that monetary phenomenon by sort of putting a band-aid on top of it. It's like a bit like having a high pressure hose and trying to stick your finger in to block it. It's not going to work. It's going to find its way around it.
Yeah, I couldn't agree with you more, but that won't stop the politicians. It's more important for the politicians to be seen to be doing something rather than doing the right thing.
Well, bear in mind, Nixon did very well out of that. And I think it was back in that phase where Nixon famously said, solutions are not the answer. So I think what he meant to say by that was saying, we don't really want to solve the problem. We want to use this problem to our political advantage, and we want to make it seem like we're doing something very, very forceful and impressive, and demonstrate our leadership in this time. And that's what he was able to do. And he rode on into a very convincing victory after that. So the public can be fooled as well by these kinds of strategies and approaches. So the politicians might not do the right thing, but the public might not know they're not doing the right thing either. So that's going to be problematic. And I think it's going to tempt Joe Biden to go in that direction as well.
Octavio, you're like painting a very bleary, cynical picture of what's about to unfold here. And how do you prepare for what's going to happen here?
Don't just survive, thrive. The Financial Survival Network.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, what I'm doing personally, I wouldn't necessarily advise this to anyone, but what I'm doing personally is putting as much in cash as possible and waiting for the opportunity to buy back into the market after the Fed basically, I think, will lead to a strong correction, and jumping into the market after that. So I think right now is a good time to stand on the sidelines for a bit, hold as much cash balances as you can, and then get ready to jump back in. But like I said before, timing these things is very, very difficult. It's almost impossible to do. But I think these are going to be dramatic swings. These are going to be big swings in both directions, both down now and then back up, I think, afterwards.
Don't you think it's a good time to be a debtor?
Well, if now the Fed tightens interest rates, increases them, and you're on variable rates, no, it's really bad. And if as you pointed out before, there's a risk of some sort of deflationary spiral, that's the absolute worst time to be a debtor. So it's really hard to say. But of course, in a very inflation environment, being a debtor is a wonderful thing. And in a deflation environment, the opposite is true. You want to be on the other side of the equation. And that's a real part of the problem with this kind of monetary policy. It turns us all into speculators at a certain stage. You can't help but speculate, and you're forced, whether you want to or not, to taking big risks. Even if you just want to sit on cash, sitting on cash is a very risky strategy. Inflation might evaporate your cash pile quite quickly. So even if you're going to take the safest of the safest approach and say, I'm just going to sit on cash and not do anything, it could get wiped out really easily. So we're all forced to speculate, and the whole process starts to feel somewhat arbitrary, where some people make huge amounts of money and some people lose huge amounts of money for no particular reason other than the Fed is sort of capriciously increasing, decreasing interest rates.
Yeah, well, the one thing is, if in fact inflation is well in excess of 10%, and we should define inflation to say that it's increase in the money supply that eventually results in an increase in producer prices and consumer prices. If it's going at 14% and you can buy a new home and pay 3%, all right, then you got a negative 11% effective real interest rate. And if it goes on, which we know that once the inflation genie is out of the bottle, very difficult to put it back in. If that goes on for a while, you're making 10, 11% a year from inflationary profits.
Absolutely, yeah. That is fabulous if you're on that end of the equation. So yes, if you've bought a house at that kind of interest rate and you have that tied in, that's wonderful. So that is, you're absolutely right there. It's wonderful to be a debtor, to have taken up as much debt as you can on at fixed rates, preferably, and just to ride that out. And if you have a sort of a hyperinflation period, then you can pay back the entire mortgage on your house for probably 1 hour's wages. Yeah. I'm not suggesting things get that bad, but
right. Better. It's better that they don't get that bad, and we just go on for 4 or 5 years when you've got making 10% on your money effectively. That's not such a bad thing.
Absolutely. If you are a homeowner who has a mortgage on the house, then it's fantastic. Yes,
and
absolutely. Your debt just gets evaporated. Yes.
And if you're a business who can lever up their assets and make cash flow on them, regardless of what your business is, then that's a good thing as well, isn't it?
Absolutely. I mean, you're doing it at somebody else's expense, obviously, right? So, so you as the debtor, you're profiting at the expense of savers. So there's basically a transfer that takes place between one group in society and another, and that's basically, I suppose, my question is that an equitable thing to do? Is that a reasonable thing to do? And is it in society's interest to do that? It's basically rewarding people for taking on debt. I mean,
obviously, the answer to all those questions is no. All right, it's a bad thing. You should be encouraging thrift and savings. But we've got an era of reckless, out of control governments who have absolutely no interest in reining in the debt. And they seem hell-bent on just destroying the economy at every level. So do you sit around and wait and save like a good little citizen or plebe? Or do you actually go out and take advantage of the system and make a fortune in the process, right?
Well, given the choice, I take the latter rather than the former, if you can time it correctly. But the
time is now.
Yeah, time is now. Yeah.
You don't have to time it. They've already timed it for you. Actually, be honest. So when we had the pandemic here and all of the stimulus, I was advising people to take the stimulus because for the simple reason that you're going to pay for that program, whether you took the money or not. The reason being, it was going to result in consumer price inflation. So just take the money. Hey, if inflation doesn't come, you can just give it back to the government if that's what you want to do. And exactly what I said happened. So if you took the money, you weren't quite as big a chump because you're paying for it anyway in the form of decreased purchasing power, right?
Absolutely. I agree with you 100%. Yeah.
Yeah. So all of it's fascinating. Hey, Octavio, it's always so fascinating, getting somebody's opinion who isn't in the confines of the States here, who can kind of see the global perspective. Just tell us how we connect with you on the web, how we find out more about you, read your work, etc.
The best place to reach me is at opimas.com. That's opimas.com. You can see our stuff there. And the work we do around financial markets are right up there.
All right. Excellent. If you got a question for Octavio, we'd love for you to give us an email to kl@kerrylutz.com. Make sure you get an answer. Go over to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. Octavio, always a pleasure. Thanks so much for stopping by.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.